The 2008 financial crisis was a catastrophic event that shook the global economy to its core. It was triggered by a combination of reckless lending, an inflated housing market, and a lack of regulation in the financial sector. At the heart of the crisis was the subprime mortgage market. Banks had been granting high-risk loans to individuals with questionable creditworthiness, and these loans were then bundled together and sold as complex financial products. This practice, known as securitization, masked the true riskiness of these loans and allowed them to be gambled on in the financial markets. As the housing market started to decline, borrowers began to default on their mortgages, causing the value of these financial products to plummet. This created a domino effect, as the losses incurred by financial institutions led to a lack of confidence in the entire banking system. Furthermore, the crisis was exacerbated by the use of excessive leverage within the financial sector. Many banks had taken on large amounts of debt to invest in these risky assets, amplifying the impact of the housing market collapse. When the losses materialized, financial institutions found themselves unable to cover their liabilities, leading to a wave of bank failures and bailouts. The crisis quickly spread from the United States to the global economy, as interconnected financial markets and institutions faced contagion effects. Stock markets plummeted, leading to widespread investor panic and a severe contraction in economic activity. Businesses were forced to lay off workers, causing unemployment rates to soar. Governments around the world stepped in to stabilize the situation. Central banks injected massive amounts of liquidity into the financial system to prevent a complete collapse, and governments implemented various stimulus packages to spur economic growth. However, the damage had already been done, and it took years for the global economy to recover. The 2008 financial crisis revealed deep-rooted flaws in the financial system and exposed the dangerous consequences of unchecked risk-taking and lack of regulation. It led to a widespread re-evaluation of banking practices and financial regulations, aiming to prevent a similar crisis from occurring in the future. Overall, the 2008 financial crisis was a devastating event that had far-reaching consequences for individuals, businesses, and governments worldwide. It serves as a stark reminder of the importance of responsible lending, prudent risk management, and robust regulatory oversight in maintaining a stable and sustainable financial system.